Hi everyone, hope you're all doing well. Welcome into my most popular video series that I do on the YouTube channel, which is the UK stocks I'm buying November 2025 edition. And today I've got 6 stocks for you that I bought, and as well as that, I'll also go through the stocks that I sold between the 1st of October to the 1st of November. As always, any moves that I make on the stock market are on these videos here, so you can track along with how I do. You can go back to previous years and see the stocks that I mentioned there. You can see how they've performed since that time frame. So anything that I bought, they're always on this video series here. Now, these stocks are always bought for long-term holds, so I'm aiming for 2 to 5 years. Sometimes those stocks do work out a little bit sooner than that, which is absolutely amazing when that does happen. So I thought I'd make you all aware of that before we get on to the video. Apart from that, if you could hit the like button, subscribe. We're so close to 20,000 subscribers. And I'll try to spend a minute or two on every stock. Apart from that, let's get started. Now today I am pleased to announce it is the start of the Black Friday sale. So this will be running to the 1st of December. Last time we had over 100 people join the Black Friday sale. So this is your chance to get in. It is the cheapest it will be all year to join the private group. On the private group, I post what I'm buying and selling in real time. You get a Discord to speak to 600 people about stocks every day, including me, and over 100 exclusive videos. Last week, we did 6 exclusive videos on the Patreon, and it's all available for £44 for the full year. Incredible value. Obviously, you get me there. 50% returns this year. Not too bad at all, guys. This is your best chance to get in. If you do want to access it, send me an email, jkrinvesting@gmail.com. I'll put it in the description and the comment section as well, and I'll get you on there. We do the payments through PayPal, so Patreon don't actually allow me to do a sale this big. That is how cheap it is. And as well as that, you don't have to pay the Patreon fees as well when it's done through PayPal, and that also makes it a little bit cheaper. So this is your time to join the private group if you do want to join. And if you do want to start investing, why not use eToro? I currently am a popular investor on that platform, so if you do want to join that, there's a link in the description. So let's start with the stocks that I sold. So there was actually there was 2 stocks I sold completely, and there was 3 trims that I made. A very good month once again in the UK markets. You know, people sometimes say, why invest into UK stocks? You can't make money in UK stocks. Well, we did, and it was a pretty good time. The first one was Audio Boom. So Audio Boom, what a year this has been. 209% in the last year. What a performer. And at the moment, there is rumours of a takeover happening with Audio Boom. And I just thought, okay, we've been on a good run. It's priced in a bit of a takeover. If the takeover doesn't happen, I think the valuation for Audio Boom at the moment at 38 times 2025 numbers and 27 times 2026 numbers is a pretty rich valuation. So if the takeover was to fall through, I can see Audio Boom share price having a pretty decent drop. So because of that, and just to protect myself in case there is no takeover, I thought, you know what, I'm going to do a little bit of a trim. So I did 3 trims. I trimmed for a 90% profit, 104% profit, and 118% profit. So what a performer this has been for us. Next one, Zotefoams. So Zotefoams has had a cracking year. Same again, I just looked to the run up. I saw the day traders kind of getting into this stock, saw a little bit of too much excitement going around the resource business, and I thought I'm just going to lock in some profit. So I did trim my position but for a 51% gain, and that has worked out very well because this week the stock has had about a 20% pullback. So really happy that I did trim some profit on Zotefoams. Next one, JD Sports. So JD Sports has been on a pretty good run since the tariff situation. You can see here from the tariff lows, the stock had rallied up about 35%, nearly up to 40% up. And I just thought, okay, the stock's been on a bit of a good run. We've got a budget that's making a few people a little bit nervous going up. And also with JD Sports, I don't think the financials have been that amazing considering a 40% run up. So I thought, you know what, let's just take a bit of a trim here. So I did trim the position for a 24% gain. And same again, I'm glad I did because in the last week, this has had around about a 15% pullback. So that one has worked out very well as well. The next stock I completely sold out of. I did take a small loss of, I think it was 2% on the B&M position, including dividends, which is, it's okay. If you're going to take losses, you know, that's probably the amount that you want to take. And yeah, I just saw the financials deteriorating. The management team were making me nervous. When you get that gut feeling like you think the management team aren't being honest with you, that's where I walk away from the business. And after the last update, I was listening to the business and the management team and thinking, I don't know if you're being honest here with us. So I decided to walk away from the position. Since then, the stock has fallen around about 30% and also hit the market with another profit warning. So I massively dodged the bullet. I got a lot of criticism in when I sold around about £2.35, and I am glad I did, because the stock is now £1.64. So that was a cracking decision there to walk away from that one. And the last one was Legal and General. I've just been adding a lot of new positions in recently, and not that I don't like Legal and General, it's just that I looked and I thought I've just got too many positions to manage, and I decided the Legal and General was one that maybe I just move away from. Realistically, it's probably never going to beat the market, even though it's an absolute lovely dividend payer. And it's sometimes when you get those awful markets and you do get that lovely dividend yield, you think, oh, that was actually quite nice. But yeah, it just too many positions, and I thought I'm going to have to let this one go. So including dividends, we did walk away from Legal and General for a 42% gain, which isn't too bad at all. And those are all the stocks that I did sell during the time period. So once again, a pretty good time frame for the UK stocks unlocking in profit. And also, you know, that's the benefits of having the Patreon and signing up to private group, because obviously we locked in Zotefoams a little bit profit before the drop, JD Sports a little bit profit before the drop, B&M before the stock went and fell down a significant amount. So yeah, hopefully for you guys that signed up to the Black Friday deal last year, you got your money's worth and it's paid for itself. Anyway, let's go on to the stocks that I am buying, the 6 UK stocks that I bought. Starting with number 1, a brand new position into the portfolio, which is Bloomsbury Publishing. So this has been a fan favourite in the Discord, and I've been waiting, I've been thinking, I'm just going to wait for the financials to start moving a little bit more up in the right direction. And that started happening, and I thought, okay, now I'm going to start buying into the stock. Last year, bit of a tough time for Bloomsbury. It's down about 26%. And I think that's created a little bit of an opportunity here for me to go buy the stock, because what I'm seeing at the moment is the market has gone real short-term thinking with Bloomsbury and not looking at the long-term potential. And when I mean short-term is that it seems like Bloomsbury's shareholder base is currently thinking only 3 months out, whereas if you look at the next 12, 24 months, it looks like a pretty good time for Bloomsbury. So they do pay a lovely, nice 3% dividend, as you can see here. They are a publishing company. You can see here, if we go on the website, the books, some of the authors that they currently do have here. One of the big authors is Sarah J. Maas. So she actually did not bring out a book this year. So that's why the financials look a little bit flat at the moment. But when there is a new book coming out next year, I think that could be a big growth driver for them, because she does make up a significant amount of revenue when she does bring out one of her books. And like I said, the latest earnings for me showed that actually this company is set up in a very good position. They had their academic and professional division grew 20%. That's obviously really good. They're tapping into that academic growth at the moment, which has been great to see. They also had some of their authors also some of the titles get snapped up by a multi-film deal with Walt Disney Studios. And as we know, when some of these books, J.K. Rowling, when they do get turned into films, that leads up to a big surge in the books and the demand for new titles. And what we normally see is the books end up coming out before the films, and people rush to get the book to know what happens next. So this is really good that they had also some multiple authors sign multi-film deals with Walt Disney Studios. The latest update once again shows that they have their financials massively under control, because they did also deliver full profit ahead of expectations update, which would be great to see them achieve. J.K. Rowling Harry Potter series continues to be a bestseller 28 years after publication. And what's also good is we do have the new Harry Potter TV series coming out, which should get a bit of demand going. I think that's the first Harry Potter program we've had really since the films 13 years ago, and that will probably lead to book sales doing very well. And also J.K. Rowling at the moment is bringing out, I think they're called Pocket Potter stories, so there's new storybooks as well for children, and obviously that hopefully is another good seller for them going forward. And obviously, like I said, with the Sarah J mask coming out in the next year as well, I like where Bloomsbury's going, and I look at the valuation, and the valuation at the moment is going to be about 12 times earnings. And, the company's normally been 18, 19, 20 times earnings business, so a big discount to where it's normally at. It's got a cracking balance sheet, as you can see here, hardly any debt, decent cash pile, so it can use that to do the dividends. Sometimes it makes a couple of acquisitions, which is also really good to see. A little bit of share insider buying going on. These sales here, I think, were awarded in the share plan, so not actual sales really, but the CEO did come in and buy some shares on the 27th of August and 100k worth of shares as well, so that's a pretty decent amount. So yeah, I'm liking Bloomsbury Publishing at the moment. Number 2, Watches of Switzerland Group. So I'll just make you aware, I did buy this at the start of the month, so that's when the stock was around about £3.50, and it has gone up a little bit since then. Although I still think Watches of Switzerland Group has nice upside and should push towards a £5, £6 stock. So Watches of Switzerland Group, I'm sure you've seen them on the high street, the retailer of luxury watches, one of the only places that is able to sell Rolex. Rolex do not sell directly to the consumer. They go to people like Watches of Switzerland, and then they sell them through the companies like Watches of Switzerland Group. To get approved to sell Rolex watches is actually very tricky. There's a big vetting service, and your license that you have to pay is a pretty decent fee. Now, what I like about Watches of Switzerland Group is that historically they've been a UK business, and then they looked at the UK and they went, the UK spenders are a little bit tight and the economy is not great. You know what economy is always good no matter what, and also economy that people like spending big money on, is the US. And what they've done since really about 2018 is they launched into the US, and now the revenue mix is going from 24% to financial year 23 to 42%, and in financial year 24 was 45%, and they've actually just crossed now in financial year 25, over half of the revenue comes from the US, which is great. You can see the growth rates that they've had from expanding into the US. So 101%, 18%, 38%, 46%, 36%, 11%, and they're up to 56 stores. And they've also launched a Rolex certificated pre-owned in 2013. So basically they are able to buy Rolexes off people. They get them verified as like, oh, Rolex approves this watch. And because they're actually buying in the product and then selling it out at the prices they want, they're actually making even more money off this than the classic selling of the normal Rolex watches, which has been a good driver for them. Now, this week they did come out with a H1 financial year 26 trading update, which has led the stock to jump a significant amount. You can see here revenue grew at 10%, but that key US growth that we just mentioned, growing 20% a year, which is great. They also made an acquisition into Roberta Coin, which is delivering excellent results. The UK business is still doing okay considering how bad it's been, with revenue growth up 2% at the moment. And overall, the business is looking pretty positive. You pick this company up for a luxury company as really the only way to publicly own Rolex at 10 times 2026 numbers or 9 times 2027 numbers, which seems very cheap considering the luxury market normally trades at 26 times earnings. There has also been some insider buying, as you can see here. The chairman of the board in April time, around about £3.50, bought around about 100k worth of shares, or well, 95k worth of shares, which obviously is nice to see as well. So yeah, I'm really like Watches of Switzerland Group here. I am up on the position about 18%, but yeah, I think this should be a £5, £6 stock. I think that maybe the market's just waiting for clarity around the tariff situation. And when that happens, we might see a little bit of a pop when that does get resolved. Moving on to number 3, Manolete Partners. So this is a relatively smaller position. So be very careful if you're a trading 2 and 2 user here. Liquidity will be fun. Anyway, so the stock IPO'd, did really well. And then since about the COVID times, the stock's just been on a downtrend going lower and lower. But yet financially, they seem to be moving up very much in the right direction. So what do Manolete Partners do? They are the UK's leading insolvency litigation financing company. They basically purchase these claims from the UK companies that are insolvent, and then obviously they resolve whatever the case is, and then they take the cut from this litigation case. Their mix, as you can see here, is a pretty decent mix between unlawful dividends, wrongful trading, breach of contract, breach of duty. So a decent mix, as you can see here. Now, what happened? UK insolvency market. So during COVID, as you can see here, the big drop off on this chart here, the government basically went, if any companies are going bankrupt, we will sort you out and we will help you out for the next 2 years. We don't want people losing jobs. So for a company like Manolete Partners that does insolvency, you're kind of like, that's not good. And then we got to 2022 and the UK government went, we're out of COVID now, you're on your own. And then we saw the surge back up in some of these cases. Now, what has happened is some of the weaker companies have started to drop off in the likes of 2023, and then obviously it takes about 12 months for some of these cases to get resolved, and they've really started to surge up in 2024, 2025. And what we've started to see during that time frame is more companies that had a little bit of decent cash reserves from some of the money that they might have got from COVID have started to run a little bit low. We know the UK economy hasn't been great. We know the UK government has been very anti-business, and this is a little bit of a play on the UK economy not being great. And as well, some of the larger companies at the moment that have maybe been able to get the access to the cash or bigger significant amounts of cash, they're starting to struggle. And those are the cases as well, when it's big amounts of money that Manolete obviously make more money on, which is better for them if they have more of those bigger cases that happen. They also have a pretty small chunk of the market here. You can see here that the no win, no fees fee arrangements at the moment have a lot bigger selection. So they have a lot of decent market that they can potentially take. What is also a wild card is they did partner with Barclays and the UK government that they tried to get back money or COVID loans that was taken out fraudulently. Basically, people were accessing this COVID loans and COVID support that shouldn't have been doing it. We know a lot of that went on during that time frame. Previously was managed by the UK government, and I think they got 3% of the money back in the cases. And then Manolete took over, and I can't remember the exact numbers, but I feel like it was something like 40% range, which was obviously a major increase. So they gave them a couple of cases going, see if you can get money back from this, what we think are fraudulent cases. And Manolete went, sure. And they got, like I said, something like 40% back. So Manolete, after the trial of like 100 cases, went, right, there you go. We got the money back for you. Shall we take a few more on? And what happened during that time frame is we switched from the Conservatives to Labour government. And basically since Labour have come in, they've kind of gone, we're not really bothered about it. And Manolete is looking at them and going, hold on, we just got you all this money back and now you don't want us to continue going with it. So I think the Manolete are currently pressing like, give us the cases. Like for the pay, the UK taxpayers, like why are we not chasing this money up? And at the moment they're just hitting the head on the brick wall. But if they do get those cases, obviously that could be a really good driver for them. So we'll see what happens there. But overall, we're starting to see the tick up of cases, the larger cases at the moment. And you can see here revenue growth is expected to go up in the right direction. We are seeing the return of decent profitability levels to 2 million to 3 million. And there was a little bit of a drop off because I was actually up on this position recently, and then it's had a big pullback. And they did a trading update basically saying like, just cases have been a little bit slow to settle at the moment. And the market's decided to throw it down another like 25%, which is just crazy. Like, it's hard to predict when these cases are going to complete. Over a time frame, they will complete, and you can see they've taken on more cases. So it seems an absolute ridiculous drop to me at the moment. But yeah, looks good. Previously, was absolutely flying before COVID. If you look at the financials here, and look at that before 2020, they had a 30% profit margin. But yeah, it looks like at the moment the growth is going to come back with these cases. It looks like they're going to start achieving those levels of profitability as well, which would be great. If you do start looking at 2028 and they do 5 million of profit on a 37 million market cap, yeah, certainly looks good value, doesn't it? So a big fan of Manolete at the moment. Moving on to the next one, number 4, which is Greggs. So Greggs has had a bad year. The stock is down a significant amount, down 44%. 11 times earnings. For so long we saw Greggs trading at the likes of 20 times earnings, but had a major pullback, lost its Greggs premium. Does pay a 4.3% dividend yield, which is nice. And ultimately what I think has happened to Greggs is everything that could go wrong has gone wrong this year with Greggs, which is just bad timing. Overall though, Greggs, I'm sure most of you guys know Greggs. It's on nearly every high street corner. People keep saying it's expanded to the max. I totally disagree, because if that was the case, there won't be growing revenue. So it's still growing well, but you can see here EPS was down a significant amount, and that's what the market currently doesn't like. I think it's all short-term issues. I think they've invested heavily into the supply chain, and that will have its reward next year. They got hit by the increases of the NI and the big increases of the minimum wage. And also we've had the issues with the stealing. It looks like they're going to resolve that going forward. And like I said, all those kind of three things and the warm weather, inflation, all those things have just hit it massively at the wrong time, and that's why we've seen a drop off. But in my opinion, they'll start bouncing back. Look at the moment, like I said, 11, 12 times earnings, which is historically very low for someone like a Greggs. Being previously, a really good performer. Great profit margins, great revenue growth. Balance sheet as well. Balance sheet's pretty decent at the moment, which is great. Gives them a lot of options. And ownership-wise, there's been a few decent buys inside the company as well. We've had the likes of the chairman board buy-in, CEO buy-in, but not huge amounts, which is obviously probably worth pointing out. And there has been actually a little bit of a sell there from the CFO. Yeah, I like Greggs. Next one, Taylor Wimpey. So Taylor Wimpey, I actually started buying at the start of the month. It had a bit of a dip, and they had a bit of a bounce, and then it's kind of giving it all back, which has been quite surprising. Pays a 9% dividend yield, which looks like they can afford to do at the moment, as long as the housing market does recover sometime soon. Taylor Wimpey, house builder, decent house builder. I think most of their properties do have decent reviews for what you'd call new builds. Historically not got good reputations, but Taylor Wimpey houses do seem to be a bit better than a lot of other ones. So first thing, housing shortage. We know housing shortage, massive. And the only way that you're going to fill this, and eventually a government will realise this, is that we need to support the construction and make it easier for new homes to be built. We also need to give more support on people buying homes. So, getting rid of things like Help to Buy, for example, was like an absolute shocking decision. So there needs to be more houses built. The government needs to support it. And at some point, these house builders are going to really benefit from it. The other thing is interest rates. What we have let's pause that video there. Giving the free advertisement. We're not having that. You've got to pay me for that Yahoo Finance. So mortgages and interest rates, we know they need to come down, and as interest rates do come down, hopefully that kicks on the sales. They have been very high for very long, and obviously they probably would have been lower if it wasn't for some of these inflation pressures that have been on, but hopefully those inflation pressures calm down, and hopefully then interest rates do start coming down, and that will kickstart people to move house or either go buy houses that have maybe for the last couple of years gone, those mortgages are a little expensive. Then all of a sudden you go from a 4% rate to a 2% rate. You might have a bit of a bump up in people buying houses. The last earnings, considering the environment, I thought were actually okay. They did have to put a significant amount of money aside because of the cladding issue. But apart from that, the update was okay considering the environment. 12 times forward earnings, which maybe the P ratio isn't the best thing to do with a house builder, but I'll just point that one out to you. And if they do get to, like 380 million, that'll be really nice if we do see that recovery start coming in. But if we see what Taylor Wimpey used to do on a profit margin point of view, so you can see here, they used to do, 600 million-ish in revenue, in profit, and 600 million on a 3.7 billion market cap. Yeah, not too bad at all, is it? And then obviously you get that lovely dividend while you wait. The CEO did buy about 50k worth of shares in March time. I think then we thought the housing market was just about to start its recovery. We thought a lot of interest rates were coming, cuts were coming, and hasn't 100% materialized, but you can see here people are ready and eager, thinking this is going to bounce back sometime soon. But you know, while you wait, you just get to sit there as well, don't you, and get a lovely 9% dividend, which isn't too bad at all. And that moves me on to my last stock on the list, which is WH Smith. So these guys, they got hit by an accounting big balls up is the best way to put it. And the stock fell massively. And I thought, you know what, there could be some issues around this accounting thing. You know, have they been fudging the numbers? I think it's just the CFO and he's had an absolute shocker. And I think that maybe this has just created a bit of an opportunity to go buy the stock. We'll see. Obviously, that's the big risk here. Either it's pushed the stock to way too low from where it should be and it's a good opportunity, or actually there's something more serious going on here. I think it's the first one. That I think it's just the big balls up here, and I've took the opportunity to go buy WH Smith. So revenue growing at 7%. I bet you didn't think that would happen with WH Smiths. If you look at the headline group profit before tax, 16% growth, EPS up 11%. Not too bad at all, is it? Now, the big thing is they have launched a travel business. So airports, train stations, the places where you're a little bit limited, where you have options to go to, is where they're really starting to open up a lot of their stores. They moved away from the high street. You might notice they sold the high street stores off, and moving into this tactic of where there's high foot traffic, where there's a little bit more limited of choice, has been very successful for them. And you can see here when you look at the total travel business, growing at 11%, like for like of 7%, very impressive growth. What's been weighing it down is obviously the high street business, but they've knocked that on the head now, and they're now just a pure travel store business. And if they continue the growth that they have been doing, it looks very good. Look at the trading profit on the Travel UK business. Like for like revenue growth up 10%, total profit up 20%. Very, very good numbers. And this drop on these concerns around the count now have put the stock down to about 10 times earnings. And as well as that, you also do get a 5% dividend yield as well. WH Smith, because of its expansion to worldwide business and this growth here, last few years has had a big re-rating from about 10 times earnings up to about 21 times earnings. And even before we had this situation with the accounts, it actually got up to a 24 times earnings. So let's assume that, okay, the accounts are a bit of a balls up. It takes about a year to get through the situation of the account issue. Let's have a look at these levels of profitability here. So if we go on Simple Wall Street, and if you do want to sign up, there's a 40% discount code to Simple Wall Street in the description, guys. If they do about, let's say, 100 million of profit on an 800 million market cap, looks very, very good. You know, you're going to be dropping all the way down to 9 times earnings. And like we said, you know, this has been re-rating up to a 20 times earnings business, 25 times earnings business. So if they get the trust back with the market after if they start doing some decent updates, all of a sudden there's some really nice upside. And even if upside doesn't materialize that much, well then you also get to pick up that 5% dividend yield. So yeah, I'm liking it at the moment. So a little bit risky with the account issues altogether, but yeah, not too bad. And that is all the stocks that I bought and sold between the 1st of October to the 1st of November on the UK side of it, guys. Hope you enjoyed it. Once again, another long one. I think you guys do enjoy the long ones though, so hopefully that is all okay for you guys. Hopefully I see some of you guys on the Black Friday sale, guys. Like I said, it'll be in the description and also the comment section. Send me an email if you do want to take the Black Friday deal up, and I'll try to get back to you as soon as possible. I reckon the demand is going to be pretty big, so if I don't get to your email in like 24 hours or something, guys, give me like 2 or 3 days, because sometimes it can be, yeah, there's a lot to get back to. So, yeah, hopefully I see you on the private group, guys. Apart from that, have a great weekend. See you later.